Hi CA students, let's revise CFN and AFM Chapter 6 Portfolio Management Practical Question 8. The following information are available with respect of Krishna Limited. Here Krishna Limited average share price, dividend per share of Krishna Limited, then average market index, dividend yield of the market index, then return on government bonds. These many information are given. They are asking us to calculate the beta value of the Krishna Limited at the end of 2015 and state your observation. For beta, for calculating the beta, this will be the formula. Beta is nothing but the sensitivity of the stock towards the market's return. Now, we use this formula to calculate the beta. Here X is nothing but Krishna Limited average share, and then Y is nothing but the market return. Then we need expected return of Krishna Limited and then expected return of market return. Then we can go ahead and prepare this. Since 4 years information are given, we can find the return from 2013 as we need a previous year data to calculate the return percentage. Now 253 minus 245 will give us the capital appreciation. Then we are getting a dividend of 25. So dividend plus capital appreciation divided by the previous year price will give us the return, which is 12.24 in the case of 2012-13, and 13-14 32.41%, and 14-15 16.13%. The weighted average of these returns will give us the expected return. Now we need the returns from market index also. So the same case goes here. 2130 minus 2013 divided by 2013 will give us the index appreciation, multiplied by 100 will give us the percentage. Then dividend yield percentage is 5%. So totaling 10.81 will be the return for 12-13. Same case for 13-14 and 14-15. Now for calculating beta, we have the returns for Krishna Limited, which is X, and then returns for market index, which is Y. Then we need XY, then Y square also for the formula. Along with that, we need expected return, which is nothing but the average. So in our case, since 3-year comparison is made, so divided by 3 will give us the average in market index and Krishna Limited in shares. So substituting this, we are getting a beta of 1.897. The next requirement is state your observation. So as we can we have to use, so we have the actual return of Krishna Limited. We have to find the theoretical return of Krishna Limited to take action whether we can sell or buy the shares. To find the theoretical return, we can use CAPM approach. Since we have the return on government bonds, which is nothing but the risk-free return in our case, and then we have market index, which will be the return on market, and we found out the beta as 1.897. So the risk-free return along with the risk premium for 12-13 is 15.12%, and the actual return is 12.24%. So as we have previously seen in our videos, 15.12% is more than, which is CAPM return is more than actual return. Hence the actual return, the stock is overvalued, because if the actual return is less than the CAPM required return, then we are earning less than the risk which we are taking based on the CAPM approach, right? So since the stock is overvalued, the decision is to sell. In the second case for 1314, the actual return is greater than the CAPM return, in which case we are earning more than the risk we are taking. So the stock is undervalued as of now. So the decision should be to buy. Then in the third case, for 1415, the actual return is less than the CAPM. Same case, the earnings are less than the risk which we are taking. So the stock is overvalued. The action should be to sell the stock. Thank you.